Hey, this is Travis Gibson from Freeman Equity Group. And if you want to learn to sharpen your axe and take down your biggest goals, you should be listening to the Small Axe Community Podcast with my good friend, Nico Salgado.
Hi, welcome to the show. I'm Nico Salgado, and I chat with top industry leaders in multifamily and business. I believe that it only takes a small axe to build a lasting empire. And if you want to learn how to use your small axe to accomplish your biggest dreams and goals, then join our Small Axe community and enjoy the show. All right, guys, welcome to another episode of the Small Axe Communities Podcast. Today, I have my good friend, Travis Gibson. Travis is the founder of Freeman Equity Group, which helps investors achieve their financial goals using real estate. Travis actively manages over $15 million in assets. Coming from a background in software engineering, he has a wealth of experience in defining project requirements and managing development teams for Fortune 500 companies such as EDS, ECMC, and Apple. Mr. Travis, welcome to the show, my friend.
Thank you. How's it going?
It's going great, man. So a little background about our relationship. I met this guy, Travis, in the Jake and Gino community, and we were in an accountability pod together. And this guy from day one has just been such a giving, helpful, happy, energetic, and knowledgeable person. So I really appreciate having you as a friend, and I'm glad to have you on the show, my friend.
Thanks for the invite, man. I really appreciate it.
So why don't we start with a little bit more about your background? You know, what was your past like that led you up to today?
Without going too far back, I'm a little gray hair here. Let's talk. A little bit. I'll talk about my move into multifamily commercial real estate. I had bought my first single family home approximately 25 years ago, dating myself a little bit. And my parents were single family property owners in Sacramento, California for years. So I grew up in an environment where my old man, my father, was a landlord. So I was familiar with the mechanics of single family real estate and saw it as a vehicle for achieving financial freedom. So I followed in their footsteps. My mom being a broker, did the single family accumulation thing all the way into 2008. At that time, between my parents and myself, we had over 20 single family homes here in Sacramento. And the crash came, and when that happened, the properties that I hadn't acquired in the right way, those went away. But fortunately, I had acquired some the correct way. And when I say correct way, what I mean is proper financing. I bought for cash flow, and I had maintained sufficient operating capital. Those properties I still have today. But as I got older and I started getting tired of tenants and toilets, right? My parents always self-managed. Even when we had 20 properties, we still self-managed. My dad really enjoyed going and collecting rent from tenants. Me, not so much. But over the years, it got to the point where I was like, okay, when I run the numbers, it doesn't appear as if I'm getting the best return for my investment in the equity that I have tied in these properties. So that's when I started looking at expanding, scaling in multifamily. So looked around for a while and talked to a bunch of different mentors. And I'm a big core values and trust guy. So, like I said, I spoke to five different prospective coaches. But once I talked to Josh and talked to Gino and the Mikey T over at Jake and Gino, everything kind of just clicked for me. So went to boot camp in November of 2019, got super fired up. And just from there, we started our accountability group in January of 2020, continued to network, and ultimately partnered up with some folks in the Kansas City area and started acquiring properties.
we can really sit and unpack all that. There's a lot to talk about. But
Yeah.
all right, let's start it back from the beginning of the single family era. So your parents and you were buying properties together, and was that all in Sacramento, or where, all in the same area?
Well, we had some properties. I'm originally from Saginaw, Michigan. It's a small town in the web of the mitten that is Michigan. Um, so we still have properties there, but those are primarily cash flow. And I say cash flow, I mean minimal cash flow. Um, but we could buy property there pretty cheap. So, my parents had some, had a few, but it's been primarily in Northern California, specifically in the Sacramento area.
Okay, gotcha. And so were things in driving distance, because you said you were doing self-managing?
Yeah. Yeah. Four of my properties were within 5 miles of where I lived. That made it pretty convenient. Matter of fact, I would say all of the properties that we had, none of them were further than 30 minutes, which, that part was actually pretty nice.
That is pretty. I mean, it's ideal, I guess. I've never personally managed properties. Do you think that by having that experience, it was something beneficial? And do you think that you would ever pursue that as a career, or are you done with it and you just use it as a learning experience?
Good property managers don't make enough. Bad property managers make too much. And that's really what I've learned throughout the process. The good part of it, has been, I learned a lot about proper maintenance on properties, and I learned a lot about basic construction just based on having those experiences. The thing I will say about self-managing, or just managing in general, but specifically self-managing, is the calls for service will come at the absolute worst time.
Mm.
Everyone. I've gotten calls where I've had relatives in the hospital. I've gotten calls when I've been on vacation. I've gotten calls in the middle of the night. The thing that my parents taught me, specifically my dad, is you don't have to live in these properties, but you should treat these properties like you live there. So, we got a call when I was in Vegas a couple years ago, and it was 105 here. Tenants saying the AC's out. Like, okay, I could have been like, all right, that's cool. I'm in Vegas though, so I'll take care of it when I get back. But that tenant has children, and I put myself in their situation. I'm like, okay, so I call my HVAC guy, have my HVAC guy drop everything, go over there, fix it. So but tenants and toilets, that's the issue.
And so you're done. You don't manage anymore.
Like I said, I still have 4 single families
Mm-hmm.
that are going on the market literally this week. Well, 2 of them. I have some remodeling to do on 2 of them. But the thing about it is what really convinced me was when I ran the numbers. Sacramento's primarily an appreciation market. Even though rents have gone up pretty significantly here in this area, when you look at that in comparison to property value, all of my properties except one I own outright. And when I run the numbers, cash on cash, those properties end up being somewhere after expenses around 3.5% to 4% cash on cash.
Yeah.
And I still self-manage those properties. So it's not like I'm, you know what I'm saying? So literally one single move out, I'm done, like for the whole year.
Yeah.
So once I saw that, I'm like, oh, wow. And then what really kind of solidified it in my mind was I invested as an LP in a deal. And it didn't really click in my mind that, okay, like I'll actually get I mean, I knew I would get a return eventually, but it didn't really resonate in my mind until I actually got a check. So once I got a check, I'm like, okay, wait a minute. I could take the equity that I have in these properties and invest them in other multifamily properties, get twice the return, and have none of the work.
As an LP, right? I mean, look.
As an LP.
It's crazy. I have friends that are doing the same thing. They're realizing the power of being an LP. And it's like, look, some people want to be hands-on and some people need that Other people don't. Some people really want to be hands off. And you know what? Being an LP for those people, it's like the work is fairly minimal. You just got to get a basic understanding of how syndications work. You invest in with the right syndicator, right? The right operator, and you stick with them for a while, knowing that they can perform, and you're freaking golden, man.
Nico, I say it, I tell anybody that wants to listen now, look, if I had sufficient capital, I would just be strictly an LP.
Me too.
Yeah. If I found really good operators, and I know some, the work involved in being an operator, you don't truly appreciate until you're actually in that position. I know I didn't, honestly. I was like, oh yeah, how hard can it be? Find a deal, and you find some investors, you throw them together by the window out being, peanut butter and jelly, you're in the mix, right?
Yeah.
And it's, I mean, even the financing part of the first deal that I did, it was a lot more work than I thought it would be. Just in terms of, talking to brokers and talking to lenders and trying to develop relationships and, figuring out, okay, do we want agency debt, or do we, are we looking local bank or CMBS? Or I was fortunate in that one of the other KPs on my first deal had 2 other deals that he had done. So a lot of these questions that I had, I was able to kind of pose to him. He's like, oh, well, on this deal, I did it this way, but, I'm thinking I probably would have developed a relationship with a local bank instead. And that's what we ended up doing. So yeah, there's a lot to it.
Was that the first multifamily deal that you did?
Yeah.
Where was that, in Kansas City?
Yep.
All right, let's talk a little bit about that. Now I'd like to get the perspective because you're still active in that, right? Because you have an LP position in other deals, but now this is an active role. And let's talk about the differences, man. Let's hear it.
Okay. Well, I'll tell you, everything has been new. So when we first got the accepted LOI and started doing due diligence, I had underwrote probably 200 deals, at least in over 6 months. Like, I was doing a couple a day for a while.
Well, let me stop you for a second. Did you have strict criteria of what you were targeting and where?
All
right. What were you targeting?
Okay. So once I identified my target markets, which is kind of a mistake in and of itself, you really just want one target market and you drill down on that. But that's, I had like 3, which my coach is like, no, he's like, you might want to just focus on one. But anyway, so I was looking for, number one, population growth. So I wanted to get at least 2% population growth, at least 2% job growth. I wanted an MSA with at least 500,000 people. And on top of that, I also wanted diversity in the employment space. So it's kind of why I settled on Kansas City, is because it kind of checked all of those. But I'll be honest, Kansas City wasn't even on my radar. It wasn't until my partner mentioned that he had invested there and that it was a good market that I even looked at it. Like, I had looked, where everybody looks: Dallas, Houston. I had looked Atlanta. I had looked San Antonio, Austin, which I really like as a city. Reno, Vegas. So Phoenix is another one. A lot of good markets, but ultimately what kind of solidified it for me was Kansas City had all of those check marks, but on top of that, it's a cash flow and appreciating market. So you get the blending of both, because there's other markets where you can appreciate very well, and there's other markets where they're all cash flow, but good luck selling it. So finding that balance was super important for me.
Wow, man. Yes, it's very important. And I've been, I've been looking in Tampa, and, it is more of an appreciation play than I had anticipated in the beginning. And so now every time I'm underwriting deals, it's like, in order to get that year-over-year average, high cash return, it's like, we got to do a sale. We got to do a sale in year 7 or 10, and it's like, you can come up with some strong, returns, but you're not going to get that cash on cash year over year if you don't sell, you know?
Yeah.
So let's hear a little bit more about Kansas City, man.
Here's the thing. The next thing I learned was after due diligence, which, going through leases and financing will make or break your deal. Proper financing is super important. Like, I cannot stress it enough.
Mm-hmm.
It really is the difference between a deal that'll work and a deal that won't work. In our particular deal, I really wanted to try to get 3 years IO, interest only. But the relationship that we had with the community bank was more important than the IO, because, initially we pressed, we probably could have gotten it. The LTV would have been higher. I think if we had come in, we probably could have got in. We came in with an 80% LTV, which is, it's pretty good. The bank itself, a Cornerstone Bank, shout out to them. They initially wanted one of the GPs to have a 10% stake in the deal to be local. So we had to negotiate that kind of out of the deal because, we didn't have anybody that we wanted to give 10% to, right? So that was kind of the negotiation. We ended up with 1 year IO. Our interest rate was 4.1, which, not horrible, but not great either, particularly now. So you get some people are finding deals, mid threes, low threes. And if you want to go agency, that's definitely possible.
Right.
So the term is, we got a 5.25. So, so far as that deal is concerned, what it allowed us to do is to hit our a 9% perf and our 14% IRR, but we approach it with a 5-year exit, right? So ideally, if everything goes right, we're looking at a 5-year exit on that deal. And I don't see any reason why we won't hit that. Honestly, when everything is said and done, I expect a 2x multiple.
That's awesome.
Somewhere around there. At least 2x multiple.
And how many units is this one?
Well, the Grocers Warehouse deal, there's 14 loft space, and then there's 6 retail spaces. So those commercial spaces obviously make up the bulk of the revenue that we generate from that asset. And so far as those 14, they're about 30% of the total revenue for the property itself.
Interesting. Now,
but the entire building is over 80,000 square feet. It's 2 buildings, 80,000 square feet.
And you took on investors for this?
Yeah, we syndicated the deal, 506B. I was on the fence whether or not we wanted to go B or C. My partner really wanted to go B, and in hindsight, it really made a lot of sense. What it allowed us to do is we brought in some other people into the deal that probably wouldn't have had an opportunity to invest in an asset like that. But part of what we do is education too, right? Not like formalized education, but more you can learn about what we do. We're completely open and transparent, right? So if you want to kind of figure out if this is something that you want to do, it's no problem, regardless to whatever your investment was. It's, we're an open book. And one of the things that my partner is Angus talking about is he wants to kind of formalize that into a process where other people have educational platforms, right? But it's like, here's the education. Now go figure out how to actually do the deal. And what he's suggesting is we find deals and then find folks that want to get started in multifamily or in commercial real estate and bring them in. And as part of their investment, they learn the process. And I'm like, wow, that would be different. No one really does that.
They're going to be, which side are they on? They're LP? Are they passive still?
They would actually, depending on what they wanted to do, we could formalize this so that they could actually get a GP share.
Yeah. Is there a price point for that, or it's just their desire?
Well, I think it's more deal based and kind of the value that they bring, right? If they're just bringing money, okay, you can certainly, bring capital and just kind of sit on the side and watch what we do and learn from that. Or if you want to be more involved, then we can figure out tasks that meet your skill set and assign you those, right? So it doesn't necessarily have to be a one size fits all. Like, depending on kind of where you want to fit in is how you would fit in.
That's
As an
great.
idea.
I've actually been thinking of something similar because, you can take on people. I find a lot of the people that I talk to are not necessarily interested in being passive until they go through a deal cycle, right? So,
Mm-hmm.
when, because we all want to be well, a lot of us want to be active and want to be hands-on and want to really just have some control in what the property does and just kind of just be a big part of it so that it's more rewarding for some of us.
Mm-hmm.
Now, if you were to take that model that you guys are presenting and take people on as a GP, teach them the process along the way, I mean, that is just a huge value. And then afterwards they can decide whether or not they want to pursue that or not. But then you still have built that relationship, a valuable relationship where they're comfortable and investing with you and feeling confident in your skills. So then you automatically have a great LP right there.
And honestly, it's kind of organically what happened with our deal. The grocers deal kind of came together like that. And that's when, my partner Ang was really talking about this idea of kind of an educational deal, right? So you're bringing the theory and the execution together. Like I said, nobody I know is actually doing that. How it ends up shaking out, I'm not sure, but it's something that I think a lot of people would be interested in.
I think so too. I've been talking to a lot of people that are definitely even showing that interest now, but it's just not available for them. So put it out there, man. Rock that.
Yeah.
Let's talk a little bit about the deal itself. So this is a new area for you too, because typically we've been trained to look at multifamily, but now you also have commercial space. How did that go?
I didn't have a whole lot of experience with it. Fortunately, my partner did. But the thing about it was, after I underwrote the deal and understood like things like triple net leases, like I wasn't really privy to, I didn't really understand that part of it. And I'll give you a for example of what I'm talking about. He initially sent over the C12s, all the leases. So I run the numbers and I'm like, he's telling me this is it's 2x multiple. And I'm like, really? He's like, he's telling me with the cash on cash. And I'm like, really? Because, I'm like, okay, you're saying cash on cash is 11%, but the number I'm looking at like 6%. Like, something's not adding up here. So then as we start talking, he goes, oh, wait a minute. He's like, okay, you include all these expenses in your underwriting, right? He goes, but we actually get all of those expenses back in the triple net lease. And I'm like, oh, okay, now it all makes sense. So, once I ran those numbers again, I'm like, okay, it's a cash flowing deal. And I'll tell you what really solidified it for me was actually seeing the property and actually meeting with the tenants. Then that's when I felt a lot more comfortable about the deal after that, in terms of, first of all, properties. The video that I posted really doesn't capture that area. And the tenants themselves, the quality of those tenants, I don't think you're going to ask for much better in terms of retail tenants. There's no like big anchor stores or anything like that, but these folks they've been there. Some of the tenants have been there over 10 years. So I felt a lot more comfortable with kind of that transition. And then on the multifamily side, I understood that part already. So my partner was really kind of key in helping me to understand that, okay, we have this warehouse space, we have this commercial space, but what we can do is we can chop this up. And I'll add this one point as well. In this COVID market, the thing that we're noticing now is, believe it or not, there's an uptick in commercial property, but it's people moving from larger to smaller, right? People still want to be in business, still need someplace to store whatever they have for inventory, but they don't need a storefront anymore, right? So we've had those kind of inquiries, and to respond to those inquiries, what we've been doing is working with our contractors to actually repartition some of our existing warehouse space to accommodate those new tenants.
Wow,
it's been a learning experience for sure.
I'll tell you, that's interesting. So Like, I don't know too much about the triple net lease. However, I was talking the other day with Dwayne Settles. He's in our program also, and he's working with Marcus and Millichap to be a broker on the triple net lease side, which is pretty cool.
Yeah.
Now, but he's saying, with a triple net lease, you're pretty much guaranteed. It's like mailbox money, and
Hmm.
the risk is fairly low, and you're getting quality tenants, like you said, with typically bigger named companies. And
Right.
I think it's just something that's can ease people's minds, especially during these times of COVID. Like you're saying, guys, this is July 20th right now, 2020. So that makes sense. So now let's say you don't have to necessarily lower rents to get, a tenant in there. You would have to get a tenant that was, let's say, downsizing their, right? Is that what I'm
Hmm.
hearing? So they would
Yep.
downsize from where they were before into a smaller unit, and now you're actually adjusting or considering adjusting the physical dimensions of certain units. Is that right?
Yep. That's exactly what we're doing right now to accommodate. Well, there's one tenant, but probably there's another one that we have lined up that's also interested as well in doing something very similar. So the big thing with that is the TI, tenant improvements. Making sure there's a balance between what the tenant needs from an improvement standpoint to the space versus not only the lease, but the viability of that tenant, right? You kind of have to quantify all of that to figure out whether or not it actually even makes sense.
Mm-hmm.
So in this particular case, we're looking at a TI repayment of about 10 months. And if they sign a 3-year lease, you're basically looking at guaranteed money on the back end. What's that?
26,
26 weeks. I mean, 26 months.
26
So
months, right?
yeah.
That's awesome.
And yeah, so that's all of this has been learning for me though. Like, I didn't know, you know, 4 months ago, I didn't even know what TI meant. So it's it's been it's like getting it through a fire hose, man.
Yeah, right.
For
That's
sure.
cool. So now that you're active in this deal, do you think so? Are you getting similar returns that to the way you would as a passive investor? Did you put money in?
Hmm.
Okay.
Yeah, actually, I invested in this deal, um, and like I said earlier, but I always feel weird asking my investors to invest in a deal that I don't have my own money in.
Hmm.
Is kind of an alignment of interest, and if I have skin in the game, it's my expectation that somebody that is asking me to invest in a deal also invest in a deal. I'm invested in this deal. I'm invested in the other deal that I have in Kansas City. And then that's why I'm looking at freeing up more capital by selling some of my single families to invest in more deals.
And do you plan on staying in Kansas City for now?
No, well, probably. Um, I actually have been looking in Michigan as well. Um, Grand Rapids, Lansing. I have some relatives there, and I know a little bit about that market. But for the time being, Kansas City there's still plenty of opportunity there. We're actively looking at deals right now there.
And do you enjoy being active? And do you feel like you're going to continue to be on the GP side?
I think so. I think so. I'm gonna tell you what I'm really starting to enjoy more than anything else. The operating part is one thing, but kind of the teaching and the sharing of these investment opportunities with other folks is kind of what is becoming my passion now. Talking to my relatives and friends about, look, you can keep trading your time for money, or you can figure out a way for your money to work for you. And just sharing that more than anything else, because I'll tell you, when I first started trying to raise, I was hesitant because I feel like I was asking people for money, give me money for a deal. But it wasn't until I actually started truly understanding the value of what what those investments can do, that I had a mind shift where I'm like, okay, this is the opportunity. Like if somebody had presented this to me 10
Mm-hmm.
years ago, I'd have been all over it.
Mm-hmm.
I wasn't aware. That's the
Right.
part I enjoy more than anything.
I agree, man, and that's great that you're shifting in that direction because it's important. It's like a raising of awareness and consciousness that people need because these tools are out there for people to be able to live a life that otherwise wouldn't happen if we consistently do the grind of the W-2. So
Yeah.
I hear it, man, and I'm going that path too. Let's you said you have another deal in Kansas City?
Hmm. Yeah,
Okay,
this is a
talk
smaller one.
okay, briefly, let's talk about that one too.
No problem. This one's a 26 unit. Um, it's a it's your standard multifamily deal. There's one, two, three, four. There's fourplexes, five fourplexes and three duplexes as part of this deal. Straight cash flow deal. The returns are about the same. We're looking at that deal is at 8.5% perf. And that's the other thing. Let me touch on that briefly. There are some syndicators out there that are not offering preferred returns. And I get it. They're moving more towards, okay, well, the split, we'll adjust the split to kind of make up for that. But I'm a firm believer in, if you believe that you're a decent operator and you believe in the deal, you shouldn't have a problem with a preferred return. But that I'm going to climb off my soapbox now. Yeah, that deal, that's it's an 80% LTV. That deal actually is a 3-year IO. Of course, that deal's quite a bit smaller than Grocer's Warehouse. That deal's like 1.9. We're running a 3% acquisition on both of those deals. And I know when I was an LP, I thought, oh man, what are you getting 3% for? 3% acquisition, that's a lot of money. Not as much as you think. And there's a risk when you first enter a deal and put up earnest money that people don't take into consideration. Like, you could be in a situation where you're out tens of thousands to hundreds of thousands of dollars, depending on the size of the deal, before you see $1.
Right.
So if that deal falls apart, something happens, that money's just gone. Like, it's the cost of doing business. I don't believe in nickel and diamond people, but that acquisition fee, you earn that money for sure. At least I know in our deals we have.
Do you have an asset management fee as well?
Yes, we have annual asset management, but the truth is you kind of have to have it.
Yeah, I agree.
In a perfect world, you could just say, property manager, asset manager, here you go. Just make sure everybody gets their checks and we're done. But truthfully, the other part of it is, and this is something that I'm really starting to understand and enjoy more, is investor relations. Super, super, super important. And I didn't realize it until I was an LP, right? Once I'm an LP, I'm like I don't need to know at a very micro level, but at a very macro level, I want to know how the asset's performing. I want to know when I'm getting my distribution. Am I getting my distribution? I want to know, are we on target so far as the exit? Just that communication part of it is huge. And learning that part, I can't stress it enough.
I agree. But even on top of that, from an LP perspective, a passive investor perspective, if you're looking at a deal and there's a 3% acquisition fee and then no other fees, you could be afraid that the syndicate is going to run off, So It's good to keep them motivated. They should be getting money. They should be getting paid for the work they do. So as a passive investor, if you see that they're getting some money as an asset manager, good. That's where they should definitely be getting paid for. That'll keep them in the deal, keep them working actively for you. So I like that. Well, let's talk. Hey, man, you also invest in stocks. Is that right?
Yes.
Let's talk about it, man, because you're an investor. You're a pure investor. You put your money to work for you. Let's talk a little bit about that.
That's another area that I'm really starting to target. Working at Apple in IT, there's a lot of people in tech with a lot of capital that they really don't know what to do with. A lot of people just leave it in their RSUs or leave it in their company stock because they're not really comfortable with investing that money. I know because I know, my investment pool is those people. And here's my thing. As an active stock investor, an active options trader, I understand that, the pain of that capital gains. And that was another reason I really dove all the way into multifamily and commercial real estate. Was I had these huge capital gain tax bills year after year. And it was always me dreading having to give that money, to the IRS and to the franchise tax board here in California. So once I saw what commercial and multifamily real estate had in terms of tax benefits, I was all in. 100%. And on top of that, this concept of qualified opportunity zones, it is a phenomenal tool for deferring capital gains while your capital continues to work for you. I mean, we could do a whole show on qualified opportunity zones. As a investment vehicle and a tax strategy, it is absolutely phenomenal. But with that being said, yeah, if you have capital gains, you as part of your overall portfolio, you should definitely be looking to offset some of that tax liability with with depreciation from real estate. No doubt.
That's awesome. Awesome advice, man. So you have a very diverse portfolio. As an investor, your mind is open to multiple avenues, multiple streams of revenue. I think that's excellent, man. And a lot of people can take away some great advice from everything that you've been saying. You know, I think in the future, as we accrue and gain more, you know, capital and equity for ourselves to invest either passively or actively, it is important to look at those 1031 exchange programs, what were you talking about for the qualified opportunity zones as well, where the tax advantages are just huge. And I think that it's very important for us as investors to consider the long road and the bigger picture, you know, because there's different strategies for investing. And sometimes you're going to be taking on riskier investments, typically like earlier on in your career, where you can potentially gain more. And once you have more and more capital, that capital can be deployed for you and work for you, work harder for you than the slow appreciation of making, let's say, smaller returns throughout. So in the beginning of your career, you typically want to be a little bit more risky, take some more chances, get some capital, utilize that capital, put it to work for you in more safer, secure investments. Once you have enough that would be able to cover your living expenses. That's the theory behind it, right?
Well, and I'll tell you, the one thing that I've done in the past few years is I have funneled gains from the stock market into real estate, and it's the best move. It's something I wish I had done years ago, because here's the thing: if you invest in the market, you're only as good as your ability not to draw down. Anybody, and I mean anybody, you could take a chimp and put a dart in his hand and have him throw at a dartboard, and he can make money. Can you hold on to the money?
That's right.
I tell people all the time, I've probably made $20-30 million in the market over the course of my lifetime. How much of that have I held on to is the question. Mm-hmm. It's the drawdowns that, and all these hedge fund guys, they all go through it. I don't care if you invest in the market long enough, you're going to have a drawdown. It's going to happen. It's how you manage risk. The better you are at managing risk, the more successful you will be long-term.
Awesome. Great advice, man. That's great, man. So, all right, let's take a leap forward. What's next for Mr. Travis?
Let's see. More deals, bigger deals. Oh, and that's something else too. I had Mikey T. I've had a bunch of people tell me, I was like, I want to start small, get my feet wet. If you can do a 25 unit deal, you can do a 250 unit deal. The work involved, it's almost the same. Really, the only difference is the raise. Mm-hmm. The mechanics of the deal they're almost exactly the same. Now, if you're not syndicating, it's different. But if you're going to syndicate a deal, when you're putting together PPMs and OMs, and you're having to set up an investor portal and have investor meetings and webinars, the work involved for a 50 unit and a 500 unit is negligible. The difference.
Right.
The one thing I will say, and like I said, Mikey told me this and I didn't listen, but as crazy as it sounds, don't look at the price. Look at the deal.
Right.
If the deal is good, that's all that matters. The price you can work out. If the deal's good enough, you'll find the money.
That's right. It's fun, man. I've been looking at deals, and I took that advice too. And I've been looking at some huge deals and finding terrible returns on that. Where then I flip it and go back to smaller deals and finding good returns. But currently, we're looking at bigger deals also. And I think that it's just exciting from an
Yeah.
active perspective, to look at these bigger deals and see really what you can take down as a team. So that brings me back though to, I know you had some issues or you had some concerns about raising capital during the COVID because you guys closed not too long ago on this one
Hmm.
Kansas City deal, right?
I had a bunch of investors pull out. I had a bunch of soft commits before, and it's understandable, right? People are worried about a global pandemic, so that part I get. And the only thing I could do was to move forward. I mean, some of these folks, I'll be honest, even my folks, my parents, I even offered to backstop their money.
Yeah.
That's how confident I was with this deal. My mother, she worries, so, and she's a realtor, so she was like, well, I'm worried. So, I'm like, okay, you know what? Don't worry about it. It's fine.
Mhm.
But the thing about it is making sure you have sufficient cash flow and sufficient operating capital I cannot stress it enough.
Mm.
If you over leverage, particularly now, because there are people, you would think prices would be going down. They're not, at
Right.
least not yet. If you over leverage a deal, somebody's going to get hurt. Like either you're going to get hurt or your investors are going to get hurt. You're going to be in a situation like some people, some big guys who stop paying distributions.
Mm-hmm.
I'm not going to mention anybody's name. Right? I'm not going to mention anybody's name.
Whoa. I've heard of
I'm not going to
plenty,
mention
man.
anybody's name.
It's
But
all out there, So I mean, it is what it is. Some people that fear is real. So regardless of whether or not there are people not making payments, fear is real. Fear is real in everybody, and that's going to cause people to freeze up and just cause things to halt or change or just definitely cause some ripples in the economy.
yeah, well, it's a legitimate concern. Well, here's the thing: depending on what the government ends up doing in terms of this additional $600 unemployment payment,
Mm-hmm.
I mean, right now, we're seeing, our collection rates on those properties are damn near 100%. But now we're starting to see situations where we had one tenant in the commercial space start asking for some type of forbearance. Like, okay, that's interesting. We should probably talk about that. More of that, we could definitely see more of that. It's a strong possibility. But when we modeled out, at least Grocers Warehouse, like I said, the other deal, I'm not worried about it at all. But on Grocers, we modeled out 30% vacancy on that deal.
Mm-hmm.
So if we had 30% vacancy across the entire asset, we can still service the debt.
That's great. I mean,
so you got to be super conservative right now. No
right.
question.
I know. We're really stress testing everything just like that. We really got to, we're pushing the max on everything, and we're just being really careful with, the offers that we're submitting, because you definitely don't want to get into a deal. Like you're saying, if you're over leveraged, you're going to lose it. You're going to be out,
Yeah.
in a couple of years. Once that interest only is done, I mean, then a lot of people are coming to that realization right now. And that's when sales are going to start happening, when they're coming out of the interest only period, and then they didn't realize that they can't really afford the property anymore.
And let me ask you this. So what are you modeling for rent growth right now?
It depends. So it depends on the area, but typically, we're still within the 2 to 3% range. However, when we're looking at for year-over-year rent growth, however, when we're looking at a pro forma, when we're projecting a rent increase with with loss to lease, we're pretty much just keeping the rents flat for the first year. So
Yep.
after that, I mean, we're going for still 2-3% increases, but we're basically going in not raising rents and underwriting for not raising rents.
Okay. Yeah. That's pretty much what we've been doing. I think in this uncertain market, I think it just makes sense, to be super conservative on, not only your underwriting, but the numbers that you're providing to investors. Like the last thing I want to do is be in a position where we can't meet our obligations. Now, anything can happen. Obviously, there's no such thing as zero risk, but I think we can be diligent in trying to make sure that risk is minimized.
I agree, man. Travis, you are so cool. Let's move on to my final question, which will
Sure.
wrap everything up. So you are a mover, you're a shaker, you're a hustler, you get things done, you're an investor. You're a good guy, man. Let's
Oh,
imagine
come on.
It's true, man. You're a really good guy, man. Let's imagine it's 100 years from now. You have kids, grandkids, great grandkids, and they decide, let's say your great grandkids decide to write a book about you, Mr. Grandpa Travis. What do you think they would title the book, or what would you want them to title that book?
I'm getting closer and closer to being a grandpa. My oldest just got engaged.
Oh,
They're getting married.
congratulations.
Yeah, they're getting married next month, so it's gonna
Wow.
happen fast. In terms of a title, when you first mentioned this, the title popped in my head immediately, and the title would be "The Juice is Worth the Squeeze."
Oh, Grandpa Travis, the juice is worth the squeeze.
It
Yes.
it has to be, and what that means. It's almost like a motto for my life. I want to do things that are worth it, and I want to do them wholeheartedly, regardless to the area of endeavor. I want to make sure what I do is worth it because you only get one squeeze, right? So I want to make sure the juice the juice is worth it.
Oh man, I love that, Travis. That is so cool. I might take that. I might make my own book. You might be like, wait a minute, you're gonna find it on the shelf of like Barnes and
Have
Noble
at
or
it.
on Amazon.
Have at it, man. And let me piggyback on that. Let me say one thing too. There's a book, and it's been around for a while, but it's new to me, called The Go-Giver by a guy named Bob Berg and a guy named John David Mann. Phenomenal book. And really what it is it's a book that explains how success is obtained by what it is that you give as opposed to what you get. And there's 5 rules in it. Like I said, I don't want to give the whole thing away. I mean, really, it could be its own show. But the crux of that book, and like I said, I actually bought the actual book after listening to it on Audible because I was that touched by it. But it really just talks about the value you give reflects the value that you get at
It's
the
awesome.
end of the day.
You're
And
right,
like I
man.
said, it's a very short book. Like you can listen to it on Audible in like 2-3 hours,
Mhm.
and it's told as a parable of this guy that's the sales guy, and he meets this guy that's a mentor, and this guy introduces him to 5 other people. Phenomenal book. I recommend it to anybody. Like I said, I hate that I'm just now becoming aware of it, but check it out. Let me know what you think.
Travis, it's funny. I just got into it also, and I do love it. So it was like a month, not even a month ago, I listened to it as well on Audible. And you're right. It's like a huge mind shift, right? It's like
Yeah,
we all go into situations thinking, what can I get? Nope,
yeah,
not the way to think. And this will definitely
yeah.
shift people's viewpoints and shift the mindset to really how we should be acting in life. And the more you give, the more you get. And really, and it besides, monetary or physical things that you get, it's more rewarding to be somebody that's giving. So there's just so much benefit to this book and to the thought process and mentality behind it.
And
So
the gift of yourself, the best gift ever, your authentic self. All right, I'm done. I can
oh
talk about
man,
that
that
book
is
for you.
awesome, man. Good philosopher. So we also got the grandpa philosopher in the house, and I think it's excellent, man.
Thanks, man.
Yeah, so Travis, you're the man. So let's hear if you can share maybe some way for people to reach out to you. What would be the best way for people to get in touch with you?
Let's see. You can hit me on Facebook at Freeman Equity Group. Just search for that. On Twitter, Freeman Equity. On Instagram, Freeman Equity. You can email me at travis@freemanequity.com, or you can call me. Give me a call on the phone. I'll talk to you. 916-538-2216. Try not to call me too late. I might not answer, but you know, the thing about it is I want to be of service to as many people as I possibly can be. And if I can help you in any capacity in your endeavors, let me know. I'm bugging you a lot about the things that you're working on. You turned me on to some fiber guys. That guy's phenomenal, by the way.
Ah, cool,
Yeah,
man.
yeah. So if there's anything you need from me, you got it.
Thank you, Travis. So the juice is definitely worth the squeeze, my man. You are the man. So let's wrap it up. And thank you, Travis. And have a great day, man.
Thank you. You too, man. Thanks for the invite. Knock 'em dead.
I would like to say thank you for listening to another episode of my podcast, where we show you how to use your small axe to build a lasting empire. Now, if you liked what you heard, it would mean the world to me if you would subscribe, leave a 5-star rating, and write a review. Also, if you want to get in touch with me, go to my website at smalaxecommunities.com. And until the next episode, keep sharpening those axes.